Separation doesn't end liability, only divorce does. And if you're living in a community property state, your spouse's tax problems can quickly become yours. A woman called my office completely confused. She wanted to know why the IRS was taking money out of her paycheck. She'd always filed her taxes. She always paid her taxes. She had no idea what was going on. So we did an investigation, and we got a clear picture. Years earlier, she had married a man in Texas. They separated, and for 10 years they had no contact. No calls, no letters, nothing. But they never divorced. She did everything right. Every year she filed her return as married, filing separately. He did that too, but unlike her, he didn't bother paying his tax debt. His tax debt grew, and then one day, out of the blue, the IRS showed up in her life by levying her paycheck. How does something like this happen? The answer lies in community property law. Texas, like Wisconsin, is a community property state. That means that under the federal tax law, income earned during a marriage is considered equally owned by both spouses, even if they've been separated for years. So when he failed to pay, the IRS treated his debt as their debt. And when it came time to collect, they didn't think twice about going after her paycheck. Now let's compare that to the state like Illinois, which is not a community property state. If the same couple had lived in Illinois, the IRS would have pursued the spouse who didn't pay. The other spouse's wages and assets would not have been touched. That's a big difference. This is why it's so important to understand how community property laws work with federal tax debts. Separation doesn't end liability, only divorce does. And if you're living in a community property state, your spouse's tax problems can quickly become yours. Don't wait until your paycheck is on the line. If you're in the situation, talk to someone who knows how to fight back against the IRS. And subscribe for more useful information from a tax attorney.